boy Kevin just lost lots of money. Poopy doopy. You're wrong. Fetch me.
Yeah. Welcome on in, everyone. This is a little bit of a tough day for the Dirty Bear. The data this week was really good. My hedges got smoked really badly to the tune of a small house in Florida. Poof. Unfortunately, I guess that's the downside of being a bear against Train America. Dirty, dirty, dirty Kevin. So where does that leave us now? Because quite frankly, the data was really good this week. PPI was pretty good. We're like, oh, okay, well, that's pretty good. And CPI comes in. It's like, oh, okay, well, that's pretty good. Now, personally, I thought that the good inflationary data would actually be bad for company and earnings, as we've seen in the last CPI reports. But instead, what we actually saw is, now we're just going to rally on everything. We're going to rally after the Bank of Japan bails out the U.S. stock market last week. We're going to rally after unemployment claims. What? When do we rally after unemployment claims? Thursday. Then we're going to rally before PPI on Monday, rally after PPI on Tuesday, rally after CPI on Wednesday, and then Iran doesn't attack. I guess the week isn't over yet, but then you get retail sales data that are just a complete blowout after McDonald's and Amazon and Disney and most companies are complaining about a substantially weaker Q3 and this weakening of the consumer. But no, you get a blowout retail sales and a really good report from Walmart. Now, I know some people are going to say and have this argument that, oh, well, more people shopping at Walmart, Kevin, is actually a bad thing because it means they're so broke they have to. And I'm like, I don't know. Or people like the fact that Walmart is responding to disinflation. It is cutting prices and people want a good deal. It's kind of like me. I want a wedge deal on real estate. I want good deals. So I don't blame people for shopping at Walmart. I actually think it's a great thing. I think everybody should just have like a Walmart Plus subscription and stop wasting time going to the store and just order it all online and have it delivered to you, I think, same day. Not an ad. Hashtag not an ad. But in this video, I do want to talk about, obviously, my recession thesis, data, and then I also want to talk about a new stock sector that I'm increasing a position in. I'm exposing myself. Okay, that sounds weird. I'm getting increasingly exposed to a specific sector, and there's a real reason why, and it'll make sense. It's the complete opposite of what we've been into earlier the year and at the end of 2022 when we called the Nike swoosh volatile Nike swoosh recovery. So far, it has been a Nike swoosh recovery, and it has been volatile, but that volatility hasn't pushed us into recession yet. And so I'm still a bear. I'm still, I'm not flipping, and it's not to be stubborn. It's that I am truly concerned about a Q3, Q4 slowdown. I am truly concerned about joblessness. And I am also concerned about deflation, which actually is a wonderful thing, mind you, for the consumer. It's just bad for jobs. The Economist, just as an example, just the other day had a fantastic piece about how manufacturers in China are going bankrupt because there's not enough to manufacture. In other words, supply chains became so loose that manufacturers are like, what? We'd gladly produce a lot more stuff. This is why I don't think there'll be a second wave of inflation. People are under this impression that, oh, okay, well, as soon as we cut rates, we're going to have a second wave of inflation because everybody's going to be able to go buy cheap stuff again. But the factories are like, please, we've expanded our capacity with new machinery and CapEx and larger factories so much. We are so overbuilt for capacity now. Please, we are built for COVID in a world that's not going to print money like that, at least in that short of time frame, likely ever again. That was probably a once-in-a-lifetime money print in that sort of condensed period of time. Don't get me wrong, we will always print money. But manufacturers would absolutely love an influx of orders. So I'm not a believer in a second wave of inflation, but I am a believer in deflation leading, which is the direction that I think we're heading into. I'm not a believer, or I am a believer, I should say, that deflation will eventually lead to joblessness. In addition to artificial intelligence, which actually comes up with this sector that I'm interested in, beneficiary of artificial intelligence. So yeah, I did close my hedges. I closed my hedges yesterday, actually after the CPI data, because I'm like, bro, everything is retailing on or everything's rallying on everything, no matter what. This is crazy. So we've just been on a week uptrend and like a week straight of an uptrend, and it's like there's no stopping it right now. I still think it's euphoric. I still think valuations are high, and I do think data is noisy. But there are a few things that I think are very, very concerning to me. Number one, manufacturing, and number two, what ends up happening when EPS growth slows down and we do get substantially more layoffs. The triggering of the SOM rule has not been wrong. We've talked about this before. We've also talked about the false fire in 1959, how it really wasn't a false fire. You did have a recession immediately after. The only reason it didn't increase unemployment as high as it did in the 57 cycle is because it literally just triggered 2 years before that, because you sort of had a double dip recession there. Anyway, so I want to talk a little bit about my current strategy and where I currently sit, because obviously things are doing very, very well in markets right now, and people are euphoric and things are rallying, and that's wonderful. But my POV is the following. First, I'm going to talk about my sort of personal game plan, and then I'm going to talk a bit about this current stock sector that I'm very interested in and why. So, current game plan, first of all, buying a lot of real estate. That's what we're doing with House. Got the House Hack shirt on, actually. Wedge deals, we're doing great. Right now, we're averaging about $134,000 per wedge deal, which is fantastic. We've got third-party valuations going on and appraisals to justify what we're doing, and it's going really, really well. So from the real estate side, we're like, at the moment, knock on wood, not missing. Like, it's going great. That's not to say there aren't ups and downs and little, things that could go more perfectly or whatever, but it's going great. Second thing is, I've started studying the LSAT. I don't know if I mentioned that, but it's just sort of a personal thing that I always like learning and always like studying something. Although yesterday I also had to sign up for some more FINRA tests. I thought I'd be done with those, but I'm signing up for the 86 and 87. It's getting kind of exciting with FINRA, so we're pretty stoked about the things we've got going. So I've got LSAT in November, Series 86 and 87 in November coming up. Been spending a lot of time playing Nerf guns with the kids, and we're going to build a little small greenhouse with the kids as well, so a lot of family time, which is really cool. But as far as the stock sector that I'm interested in, first of all, it's built around this idea that recessions are slow. Recessions don't move very quickly outside of COVID. Look, obviously, when we had COVID, we had this explosion of a recession. It made sense to have puts and hedges all day long because you had a 30-day crash. I mean, you could just make tons of money every single day because the market was just minus 7%. You're triggering circuit breakers on a regular basis, right? So that was a pretty remarkable time. But normally, when you look back at recessions, the stock market takes 1 to 3 years to sell down. And the tough thing is trying to pinpoint, well, when does that start? And then how do your hedges survive during, let's say, bear market rallies? If we're going into a recession, right? Maybe we're not even going into a recession. Maybe we're going to stick the soft landing of 1995 and great. And so that's where what I've done is I've positioned my exposure to, this might sound crazy, but actually the mortgage sector. And I'm going to explain why. First of all, in the event of a soft landing, because of disinflation or frankly even deflation, not only manufacturing deflation, but also look at the Wall Street Journal talking about hourly pay basically plummeting because there are so many people available to work at hourly wages. People are starting to get really desperate for jobs. You have Spirit Airlines laying off pilots. We literally went from pilot shortage to Spirit Airlines laying off pilots. Now, maybe it's because it's Spirit, but pilot layoffs, crazy. 250 pilots getting laid off. It's wild. So anyway, when you combine manufacturing deflation and wage deflation, you're going to have economic deflation. And I don't think you're going to have a second wave of inflation for the overcapacity arguments that I've made. So I think the Federal Reserve is on a clear path to lowering rates. So I have no concerns about CPI and PPI. I think that's just going to keep going straight down. I do have a concern that is going to lead to layoffs, which eventually leads to EPS collapse and earnings collapse and a consumer collapse. We haven't seen an explosion in layoffs beyond obviously the triggering of the Somme rule. I'm going to get a new bracket for this, by the way, one that doesn't sit on the desk, put it on the floor and I'll kind of arch over to be a little better. I'm testing this out just for this video because this is more a little conversational. If I'm using the computer and notes and other stuff, I'll have just our usual shotgun mic. By the way, let me know, which one do you think sounds better? This is the desk mic right here. And this is the shotgun mic you're probably used to hearing. So shotgun mic that you're used to hearing, desktop mic. They sound different, obviously. But anyway, so the current sector, the mortgage sector, is very interesting. Now, they had a little bit of a run yesterday because there was news about refinancing, and so a lot of people sort of bought and basically traded it, right? People went in to trade it, and then they are closing those positions today. That's pretty typical. But if you look at trends right now, and you type into Google Trends refinance, and you look at the past 5 years, you're going to see something very interesting. You're going to see right here at the beginning of August, the first week, so about the 4th through the 10th, as treasury yields were falling, you actually had a nice spike in refinance searches, which hasn't shown up in mortgage company earnings per share yet. And if you zoom out even further and you go out to 2004 to present, you see that similar spike is just beginning. And I think that trend line is actually going to keep rising because there are a lot of people who financed loans in 2022, 23, and 24 that either can refinance cheaper now, only by a little bit, or they need to because they're so high in credit card debt, they're consolidating. Now, don't get me wrong. I don't encourage you to do that. I think that's a bad idea because if you refinance your house to pay off your credit card, then your credit card debt goes to zero, and then you're just going to end up going into credit card debt again. Really bad idea. Anyway, that's just sort of a more like broad financial advice thing. It's not personalized financial advice. But the mortgage sector is really interesting because I do think refinances are going to grow. The upside of that is you actually increase the value of existing bonds or mortgages that these companies hold compared to new loans that are made. So in other words, you look at a company like United Wholesale Mortgage Company or Rocket Mortgage. They have billions of dollars in net assets, basically, assets above the debt that they have. And a lot of these billions of dollars are residential mortgages. So they're not exposed to the commercial real estate sector. They're exposed to the residential mortgage sector, which I don't think has a 2008 repeatability because we have completely the opposite set of loans this time. We don't have credit default swaps on top of, AAA rated Neg Am Ninja loans like the kind of trash that we had in 2008. Today, we have loans where people have the ability to repay. The Dodd-Frank Act forced that after the recession. And these loans are actually very tough to get. They're very, very high caliber, high quality loans. So I'm not very concerned about these mortgages losing value. In fact, I believe they're going to gain value as rates come down. As rates come down, I think the mortgages that are on the books of these companies go up in value and their refinance revenues go up. Now, there is a little bit of a downside in that mortgage servicing rights, that gets a little complicated, but just to quickly address it, they can tend to go down in value as rates come down because there's a refinance risk that gets priced in. So I found that Rocket Mortgage and United Wholesale had the highest percentage of mortgage loans to mortgage servicing rights, so more loans. And Mr. Cooper, PennyMac, and Loan Depot, which are also good, had a higher percentage of mortgage servicing rights. So I'm scaling a little heavier towards the Rocket Mortgage and United Wholesale versus the others. And now what's really interesting about this is I think this play works in a soft landing scenario and in a recession scenario. I still think we're going into a recession. I don't know when it'll be, if we'll start seeing the triggers, Q3, Q4, we're in Q3 now, if we'll start seeing the real recessionary hit in 2025, I don't know. I'm going to be patient. I think valuations are way too high to sort of like FOMO into the market. I don't really care about that. This is some personal advice for you. It's me. I'm trying to take a protectionist POV here. And my POV is no second wave of inflation, no residential mortgage crash. Rates come down in soft landing or recession. Okay, cool. That benefits earnings per share via refinances. That benefits the value of mortgages held by these companies, which increases the book value. And so I actually think that, I mean, I have a price target for Rocket Mortgage of $30 and United Wholesale of $18, which is substantially higher than where they sit today. And so for me, I look at these hot data trends that we got today as actually buy the dip opportunities on those particular companies. So I'm like, I decreased my exposure to NVIDIA to zero. My exposure to Tesla's at zero. Microsoft's at zero. I've got exposure to Apple and Amazon. Treasury bonds like TLT or UTHY. And then this mortgage sector. Because I think the mortgage sector as a whole benefits in soft landing as rates come down, or substantially quicker in recession as rates come down rapidly. And yes, joblessness would go up, right? But you have to think about it this way. Joblessness might go from 4% to 8% if there's a recession. Okay, so how many workers are there in the country? Well, you have about 150 million people who work. So take another 4% of those, and another 4% is 6 million. And then about 60% of those might be homeowners. But a lot of those, I'll say 30% of those, are two-income households. So not necessarily a default risk when, if you do that math, if I say 30% are single, so I'll multiply by 70%. Actually, no, multiplying by 30% because that's the number that I want. You've only got a risk of maybe about 1 million homeowners that could lose their job. And my belief is that a lot of those homeowners probably have excess equity in their homes to help bridge them to get to the next job or whatever, or get through the recession. So I don't think that cohort is so risky to justify sort of the pressure on the mortgage sector. Now, the mortgage sector has already started recovering. You know, it's not like we're buying these at bottom right now. So there is a risk that some of that excitement has already been priced in. But I think the market hasn't fully priced in that there is not going to be a second wave. It's my opinion. It could be wrong. I don't think the market has fully appreciated that there's not a 2008 real estate risk. I don't think that's priced in, so therefore I think these companies are at a discount. And I don't think the market has started to pick up on, oh my gosh, there are a lot of people ready and willing to refinance as soon as rates drop even just a little bit. So I'm very optimistic on this mortgage sector. I actually think over the next 12 months, it could potentially be the best performing sector. Not AI, not NVIDIA, not Tesla. I think maybe Enphase. I have exposure to Enphase. Maybe. They're sort of a bottoming sector as well, and they're kind of related, right? Enphase uses contract manufacturing, so they can sort of scale up and down their expenditures. They benefit from a not housing recession because the lower rates let homeowners borrow cheaply to install solar on their homes. So Enphase is probably in that bucket as well of me actually being optimistic on Enphase. But that mortgage sector, I think people are very bored by, and it's not very like sexy or entertaining. And so again, I think not personalized advice, obviously, but I think absent the amazing rally that's happening today in pretty much all sectors except for the mortgage sector, I think longer term, companies like United Wholesale, Rocket, and even to some extent Mr. Cooper, PennyMac, and Loan Depot are very attractive. And so for me, I maintain about a 2.9 on the bear bull scale right now. So in other words, it's a little bit more bullish from 2.5, but it's by no means, back to like bull mode or even 50-50 mode. I'm still pretty bearish. I think the inverted yield curve is inverting even more. And I don't think it's going to take a lot to really push us back into serious pain. I know today's rally day, and then of course the bears always look like fools. Usually bears just crawl into a hole and go dark and just don't show up for work on days the market rallies like this. I mean, look at this. On Enphase, for example, you literally went from my 113 line to my 119 line. It's like literally a perfect move to move. This is pretty classic. We see these lines hit a lot. Anyway, so you've got the 2-year Treasury up 16 basis points right now, and the 10-year is up 11, which means the Treasuries are getting whacked. So like TLT is on sale today, and so are the mortgage companies. But you've also got the yield curve inverting more by about 5 to 6 basis points, which does mean you have more pricing in of recession to do. In other words, The data this week has really just delayed the recession, which makes it very hard to hedge for. It's very difficult to say, okay, I'm going to hold puts through every single rally because you're just going to get smoked on them like I did. And like I always say, I can't guarantee we're always going to make money. We're always going to be perfect. The only thing I can guarantee is I'm going to show up and I'm going to do my best for you. That's the best we can do. And so I think this mortgage sector is, as Roaring Kitty would say, an asymmetric market opportunity. And it's not one that I want to day trade or short-term trade. It's something that I look at as, okay, I want to increase my exposure when rates sort of tick up like they do today on hot retail sales numbers. But numbers like today, what they really do is they delay rate cuts from the Fed, which actually increases the odds of a recession, and then it increases the clamoring of the market going, Fed, you've gone way too far. You need to 50 to 75 BP cut rapidly. And I think those sort of actions could happen between Q4 and Q1 of next year. So this does delay things a little bit, though, which again makes hedging hard. Probably the best hedge is just cash. But I still really like treasuries. Again, 20-year, 30-year, I love those because I think we'll see a plummet there. Gold, I'm not the biggest fan of because if you go into soft landing or recession, gold performs differently. Gold performs well if you go into recession, not so well if you have a soft landing. Mortgage sector does usually both well in both scenarios because rates are coming down and people are going crazy buying. Or refinancing and taking out new loans, and the ones who haven't lost their jobs. And what's wild is the value of the loans they have, as long as they're not defaulting, which that would generally only happen if home prices are really rapidly declining, which I don't see happening. I actually see them going up. Or stable to up. And it depends on where you are. Like California is doing a lot better than Texas and Florida, for example. Then the value of the loans they hold actually goes up as well. So this is a thesis. This is not a guarantee, but this is roughly what I'm seeing right now in markets. I'm not going to get suckered into the Walmart and this retail sales data coming in hot, which generally always gets revised down. But I will say the data was good. I have to give credit where credit is due. The data was good, and I paid the price on the hedges for hedging this week. But you know what? I'm a big boy. It's a number. I can handle it. And the only thing I can promise is that I'm going to be here and I'm going to show up. So let me know what you think in the comments down below. This is the shotgun mic you're hearing right now, so make sure you leave a comment shotgun or desk microphone. It's kind of cool. Anyway, thanks so much. Take a sip of this RuneScape cup, which definitely isn't filled with Kahlua or vodka or tequila or all three of them mixed together. Yeah. Anyway, thanks for being here. We'll see you in the next one. Goodbye and good luck.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.